Welcome to Romera Records virtual cast. Today we have on Steve. How's it going, Steve?
It's good. It's good. It's a good day. The sun is out. I'm still breathing. What more can you ask? You know?
Can't complain about that.
Right. I can complain about the stock market. It didn't go up today like it was supposed to. It did all that yesterday. Today it's trying to figure things out again. But other than that, and that's really not a problem when you get used to it.
Yeah, I've been hearing a lot of things happening. One of my friends, he's got some stocks in Amazon, and he mentioned he called me. He was like, "Hey, dude, I've got like one or two stocks in Amazon. It went up like $60 within the last hour." I was like, "Cool." Things
Well,
go up, they go down. It's the life of the stock market.
they do. And what people have to learn to do with that up and down, that volatility that you hear about, and some people get all upset with the volatility. And I, on the other hand, think that it's the best thing since sliced bread. I mean, if you select securities properly, the price movements on a day-to-day, even a year-to-year basis aren't really that relevant to your safety in the investment, but they do provide opportunities to trade. And I'm not a day trader. You probably heard people talking about day traders and, oh, they're no good, they're bad. It's the difference between owning a security. It's almost like a store, you know? You own a bunch of products on your shelves, like all the stocks, all the securities I own. I think of them like merchandise in my store, and I know what I paid for it. And now I want to turn around and I want to sell it, and I want to sell it at least a 5% profit, maybe a 10% profit, depending on how the economy is. Let's say people have lots of money and they're spending. My price might be 7% instead of 5%. But if somebody comes into my store and says, "Here's your 5%," they're going to leave with the merchandise. I'm going to sell that sucker, and I'm going to buy something else to put on my shelf. And that's how I deal with securities the same way. So if you have Amazon, you have a couple tech companies, you have an oil company or two, you have a Walmart and something like that in the real in retail, and then you find somebody in healthcare, and you get all these different sectors of the economy, and you own a little piece of the action. Um, they're all going to be moving up and down all the time, but maybe in different cycles.
Mm.
So there'll be advantages to buy them lower and sell them higher throughout time. So you develop a universe of these securities that you've vetted them just like you would an employee. You get his resume, you look at it, you say, "Do I want to hire this guy or don't I?" It's same with a company. Oh, the company's never made a profit. Oh, I don't want that company. You know, the company does something else. If you're green oriented and these guys are polluters, you don't want them either. So you make your own selection criteria, and you put all this quality merchandise in your sell on your shelves. You set a target price to sell it at, and bang, there you go. It's That's kind of an oversimplification, of
Yeah.
course, but
My wife, she had no stocks. This is back in 2019. She had none, and I was encouraging her to buy a stock in something. Just pick something. And she was
yeah.
using Robinhood, and
Uh-huh.
she was like, "What about Tesla?" And I was like, "If you want to buy a Tesla stock, go buy a Tesla stock." I was like, just pick something." So she was like, "Well, they do electric cars, good for the environment, that type of stuff," which, good for the environment, quote unquote. We talk about the lithium battery mining and stuff like that, but
All right. Yeah.
I digress. So she bought one stock in Tesla back in 2019 for like it was just under $200. I think it was probably around 200, whatever, and she held on to it until sometime late last year. I think she sold it in maybe like August, September, something like that. Well, they had done like two or three splits since then.
Mm,
So her $200 investment turned into about $4,000 because it had, I think it split, as I said, like two or three times. So she had about
yeah.
like 12 shares or something like that. And that's, she just literally made that pick off of what you were talking about. Like, do I
Yeah,
want to invest in something that environmentally friendly company or something like that?
right.
That was just her pick based off of
Has she sold it?
yeah, yeah. She sold it late last year.
Good. She took her profit. That's one of the key things that most newer investors, even old people like me, um, fail to do. I've in my I started a coaching business. I just sold my business in last May, and I wrote this book that you see over my shoulder, Retirement Money Secrets, and I started a coaching business. So what I try to do is to make people focus more on the income generated from their portfolios, because eventually, as I did, you want your portfolio income to replace the income from labor, the working income. You want to say, okay, if I hang it up right now, can I live off my pension, social security, rent if I own properties, and the income that's being generated from my portfolio?
Mhm.
So you get more in the driver's seat in your job if you get into the position where you're making more money from your investments than you are from working. And you can say, if I still love this, I'm going to keep doing it. But if I hate this and my boss isn't treating me right, I'm just going to, and say, okay, fella, I'm gone. I'm gonna do my own thing. I'm gonna get a podcast. I'm gonna coach. I'm gonna do whatever I want to do. But I don't need you anymore because I've developed this income. So income has always been my focus because that's what I wanted to do. I didn't want to commute to New York for the rest of my life. You
Mhm.
know, from North Jersey to New York, some days when I was young, it was a 45-minute trip. In the winter, sometimes it was a 4 hour and 50-minute trip. You never really, the only thing good about the winter, and you knew you were going to spend all this time on the bus, was that you were able to study for a master's program while you're on the bus. You didn't have to do it when you're leisure time. You know what I mean?
Oh,
So,
goodness.
so that's the type of thing. So I developed the skills and the discipline to put money away. And even when I was a kid, my father encouraged me. I had this, I was mowing lawns for people in this development where we were. And I was, you know, these were summer vacationers. They just threw the cash around pretty much. And I was, for that time, I was making some good money. My dad made me put 25% away in an account. And then when I got older and got into college, and my summer jobs were, I was driving a truck in a lumber yard or stuff like that. I started to make some what I thought of as good money. And he'd say, same thing, 25%, go play with the rest of it. And he'd put away and he gave it to his attorney who was in the stock market. Well, long story short, when I was 25 years old, he says, I got a birthday present for you here in this envelope. So he had one of those legal size, those yellowish type envelopes
Hmm.
that you see.
Yeah.
And he he dumps it in front of me. I open it up and all these stock certificates are in there.
Mm.
I mean, and you'd know the names like Royal Dutch Petroleum and IBM and General Electric, all these high quality, well-known companies, some of which don't exist anymore, like Sears. I guess I don't think it does.
I,
Maybe they
I'm,
still have a catalog service or something, but they don't have any stores, you know? So that's what I started with when I was 25. And
mm.
my main objective was to say, I am not going to lose any of this. So I started to learn about what's a stock, what is it? What does it represent? You know, um, why do they go up and down like this? Why did they act so crazily? Why do people get so upset if they go up and down? I mean, this company's been around my entire lifetime. It's never gone out of business. So why do people care if it went up or down this month and stuff like that? You know? So I studied all that stuff and I studied that stuff. And I did charts and I said, okay, it's here and there. What if I had sold it here look at this. I could buy it again at about the same price or a lower price here. And then I could do this again, and I could do it again and again. And if you go back to if you take any of these well-known big companies, you go to a 20-year chart or something, you could probably find 100 opportunities to buy and sell it at a 10% profit.
Mm.
So I said, that's what I'm going to do. So while I was working in New York, commuting, I was running this portfolio, and I started to read and do things like that. And people were saying, well, you got to make sure you're diversified and you got to look for income, and you ought to have a portion of your portfolio in safer stuff than the stock market. So I started taking in and buying municipal bonds. They're tax exempt bonds. That was my first income purchase. And it was Fort Pierce, Florida, 4% coupon municipal bond. And I bought it at issue way back then. I held it for the 30 years until it matured. That's not necessarily what I'm recommending people do, but I did. I sort of had one of those things that doesn't apply well with investments, the term loving some sort of stock or something like that. I loved that bond because of what it represented, you know.
Mm.
So anyway, I started really young, starting to develop that income side of my portfolio. So when I was in 79, when I was 79, I was 45, 79, 34. How's that for math, huh? I was 34 years old and I was in that position where I was making 5 times my salary
Wow.
on my investments. And I said to myself and to my wife, I don't think I'm going anywhere with this company. And she said, I agree. You don't kiss ass enough to get anywhere. And I said, I agree. And I think I'm going to go into the investment management business. And then, of course, she told me I was out of my mind. So she encouraged me to quit because I wasn't going anywhere, but she didn't necessarily want me to start a new business either.
Yeah.
So, but that's what I did. And I was fortunate that she was working too. She was paralegal, and I had all this income from the investment. So I was able to get something started. And I was able to show my friends who had money how I had made money in my portfolio and how they hadn't made money in their portfolios. And that's where it all started. And like I said before we got on the air, I when I sold the business last May, it was 110 million under management for 150 clients throughout the country.
Wow.
So you
So
know, and it was really the principles to get there are simple. The application may not be so easy, you know, and the time involved, but go ahead. You had a question?
I was going to say, so I guess to give everybody a little preference, most people they know about stocks. They know, you watch the stock market, you see, was it like Mad Money, the guy on TV, stuff like that.
Yeah.
So, stocks are just very volatile, or depending on the company, I guess.
Hmm.
You watch a ticker, things go up and down, but bonds are a little different. They're usually, I would say, a little bit more stable, a little more, I would say, maybe predictable of how you're going to bring in income from that. I guess, could you, and especially the municipal, I'd never even heard of that. Could you go
Oh,
a
okay.
little bit more in depth of the difference between the two and how you decided to use the advantage of bonds and municipal bonds to your portfolio compared to just, some people see something like Wolf of Wall Street and they're like, oh, I'm gonna become a stockbroker now. It's not
Yeah,
that
yeah,
easy.
there you go. Okay. I guess the basis thing is both stocks and bonds are publicly traded securities for, and stocks represent an equity interest in a company. That means you own a piece of the company. Every share represents a piece of ownership. Um, and as an owner, okay, so that's one. Bonds represent debt. The company has borrowed money from you, even though you didn't speak to the CEO directly. When you buy a bond of ABC company, they owe you the face amount of the bond. No matter what they say that bond is worth today, you will get paid the full amount of the face value of the bond. It's a debt security. Municipal debt is regular debt securities corporations are taxable in all the states and by the federal government. Municipal bonds are not taxable by the federal government and not taxable in the state in which they're issued. So,
Okay.
okay. So if you're in New York or if you're in California, um, I wish in South Carolina I could get some South Carolina munis, but I don't know if they exist. So anyway, bonds are debts, and when a company gets in trouble and it goes bankrupt, as many do, even Merrill Lynch went bankrupt actually in the Great Recession, and there was another big firm and a couple banks that also did. The people who get paid, if there's anything left over after the debtors get their money, um, the bondholders of the corporation are right up there and the people that will get some money back.
Mm,
Okay. The shareholders will not get a penny until all the bondholders have been satisfied.
I did not know that.
So as the difference between the two is that the risk of actual financial loss, not the risk of the market value going up or down, but the risk of actually losing your money is greater in the ownership in the stock than it is in the bond.
Mm,
There are also things called preferred stocks, which are uh, securities they issue. They sometimes they're convertible into common stock, which is the regular equity. But I'm not going to make this too complicated. Preferred stocks also get paid out before common stocks, but not before the bonds. Okay, so anything that's a stock is more risky financially than anything that's a debt security of the same company. Like a stock of Exxon is probably not as risky as a bond of, the store on the corner that decided it want to sell its shares to the public. You know what I mean?
mm.
So everything is relative, but for for a company, their bonds are always safer than their stock. Okay, so that's one of the difference between them. The municipal bond is just a bond that the states will sell to put a dam up on a river or something like that if the federal government isn't doing it, you know?
Mm.
And government bonds are the safest form of debt security unless one of these times Congress actually does let them default, you know?
Okay. I was gonna say, if I'm not mistaken, bonds originated from it was a war. Was it like the one of the wars we had where the government wanted to borrow money because that's like when we started rationing things, and then the government started issuing bonds so that people
Could
would
be.
give them money.
It could be. I'd never heard that, but it
I,
certainly is possible that, the government didn't take on debt. So it used to get all its revenue by taxation, right?
mhm.
So comes times when I guess if you're the president or whoever and you say, hey, we need to build a highway system across America, right?
Yeah.
You're not going to get that by taxes. So yeah, let's borrow money to make this happen. Maybe it wasn't a war. Maybe it was the Spanish American War. Who knows? I don't know. I've never researched that. That's an interesting question.
Yeah, I think that's how it was because well, I think we started rationing things and portions of, like you can only get this much, and
Oh
they
yeah, well did that in World War II for
yeah,
sure.
that
Probably in World War I wasn't alive to. I know I looked like I might have been alive then, but no, World War I I came along just after World War II, and I heard about stuff like that. Yes, there was rationing, and yes, they came up with the U.S. Those other kinds of bonds that everybody could buy some.
Hmm.
You could go out and buy a bond for $100.
Yeah.
A U.S. savings bond, what they were
Yeah.
called,
Yeah.
right? Yeah, I'm sure people still have them. I
Crazy.
never did any of those. And
You think those are
today,
still worth a lot? Like people who have those?
no, because they had a maturity date.
Oh, okay.
So they did mature. They just got paid whatever the face amount was. So the interesting thing about bonds, unlike stocks, and the time we're in right now is a great example of it. Uh, Stocks are strictly supply and demand. If your wife likes Tesla and everybody else likes Tesla, the more people who want to buy it, the higher the price is going to go.
Correct.
You
Yeah.
know, if what's his name gets in trouble with the law, the Tesla guy,
Elon.
Elon, if he gets in trouble and they think he might have some financial difficulties, the price of Tesla is probably going to go down because
Mm.
people are going to sell now, take their profits, and see what happens. So it's all about the emotions, the economy, and everything else, the stock market. Bond market is impacted primarily by where people think interest rates are going.
Mm. Okay.
Because remember, a bond or preferred stock is a contractual agreement between the debtor and the owner of the debt
Hmm.
to pay this amount of interest every 6 months and this amount at the maturity date. I got to pay you the face amount. So a 5% bond becomes higher in value to somebody who buys it in a 2% environment. Remember 2 years ago, interest rates were almost zero.
Yeah. Yeah.
So if you owned a 5% bond that you had bought 10 years ago, the value of that bond was probably like, instead of $100 per bond, it was probably $135 per
Mm.
bond because you're getting 5%, which is 5% more than that guy can get in the bank.
Yeah.
Zero, at least. So that's the way it works. So every time somebody starts talking about interest rates going up, all fixed income securities, all interest rate sensitive securities will start to fall
Mm.
because their market value gets lower as interest rates get higher.
Wow.
On the flip side, if you buy 5% bonds now and the Fed's talking about lowering interest rates, your bond prices are going to go up when
Yeah.
that
Yeah.
happens. So the thing is, when they go up, you got to sell them because it doesn't mean anything if you don't. So that's what I do. I play those changes in perspective within the market of what people are thinking about where interest rates are going and where today's mob scene is taking stock prices up. But the interesting thing, and I think the most interesting thing for two types of people, for old people like me and for young people like you and your children, perhaps, uh, is that you can own anything in the stock market and anything in the bond market in packages that are just safer because there's more secure. Let's say a young guy starting out, he gets his first bonus from the job. He gets a $5,000 bonus. And he says, I'm not going to spend this. I'm going to open up a joint account for my wife and I so that we can pay for the kids' education, 10 years from now. I'm
Hmm.
going to invest it. And we'll invest my bonus every year. Well, what is he going to invest in with $5,000? He can buy a share of this and a share of that, 25 shares here, 24 shares there, but he can't really develop a safe, uh, balanced portfolio that has both income securities and equity securities in it with the small amount. But he can do it if he goes out and buys one of three packages of securities. There are three primary packages. There are the oldest the oldest one on the planet is a thing called a closed-end fund, which was developed in the mid 1800s. And there are people who say it was developed in Amsterdam, but I haven't found evidence of that. But it was definitely in operation. They were definitely in operation before mutual funds were developed in the late 1880s. So mutual funds are not the oldest of the group. They're the second oldest. And ETFs, the popular ETFs, which are popular because they're not managed. In other words, they're
Mhm.
passively managed so that you don't have high fees as you do in the other two. And they just came around in the 90s.
Mm.
So that's the thing that's good about these types of securities is that there are four ways that you can control the risk in your investment portfolio, and that's by I coming up with measures of quality. What makes them quality? I mentioned before they've never had a profit. I'm not buying them. That type of thing. They don't pay a dividend. I'm not buying them. I need them to send me something to appreciate my ownership.
Yeah.
So you have to come up with a way of determining the quality. You have to diversify amongst all the sectors and things and types. Everything has to produce income for you, and you have to set a target profit so
Mhm.
that you sell that sucker when it gets to your profit, and then you find something else to buy.
Mm.
Those are the four principles of risk minimization, and they're outlined pretty thoroughly in Retirement Money Secrets. I think I spent half that book talking about how to protect yourself from financial loss. Okay, so those are the things. Those are really important, particularly for young people, and particularly for retirees who can't afford to lose it, and young kids can't afford to lose it because they'll never get that base started if they take too much risk when they first get that first bonus check, you know.
Yeah, and I think that's something that it's getting worse and worse with my generation. So I'm 31, and I think my generation and younger, we have become a very um, instantaneous generation. Like we want everything now. Like, we can
Mm,
use our phone to just get something. And
right.
I think that, with Uber, you can just get a ride, or you can get DoorDash and just get food now and just get it delivered. So, um, even with money, like people can't wait to, I want to get paid faster. I want to get paid now. So it's crazy how my generation and younger, I think a lot of people have a problem with thinking about like bonds or thinking about long-term gain, 401k, and put your money
Mm.
away and you'll get it back later. They're like, "What?" Like, "No, I want money now. How
I
can I
want to
make this
spend it
now?"
now. Yeah. Yeah, I don't know what to say about that. I guess I had that mentality, and if my dad hadn't encouraged me to put money away when I had my part-time jobs as a kid, I probably wouldn't be where I am today. Really, because I wouldn't have done that. I wouldn't have had that hunk of stock certificates dumped on my desk when I was 25. I didn't even know they were there. I didn't know they existed. I
Mm,
was, just getting by with my salary at that time when I got my hands on that. So, I think a lot of it's up to parents to see the light for their kids.
yeah,
I
yeah.
mean, you're 31, you know that problem now. You've got to start doing something if you haven't already. Uh, but your parents probably were doing that already, and hopefully they coached you a little
A,
bit
a
on
little
it.
bit. Yeah, my parents never really talked to me about that stuff, but
Well, hey, I've got grandchildren that are just I got one that's almost your age, and I've got another one that's turning 21 in 8 days. And believe me, she works at a resort, this resort where I live, Kiowa. I don't know if you heard of Kiowa Island. It's a big golf community and resort down here in the Carolinas, south of Charlotte. And she gets a job there every summer, and she makes super money. I mean, the people that come and stay there in the summers are paying more money for babysitting
Mm,
than you just can imagine.
Yeah.
stuff like that. So she works in the resort, and the kids like her, and they get their parents to hire her as a babysitter, and she does great. And getting her to put any of that away is almost impossible. Almost impossible. She just doesn't want to hear about it. You
Yeah.
know, that's what you're there for, Grandpa. Okay, you're gonna take care of me. But she's a good kid, and she's certainly got the initiative going forward to get a good job. I mean, she's working hard at that.
Mm.
But when it all clicks, that you will become that old person that's talking to you. You will become that person someday, and when you're that person's age, you're gonna you're gonna want to see the world. You're gonna want to have enough money to do everything that you haven't done yet.
Hmm.
You know, so the sooner somebody gets that eureka moment, that light bulb goes off, and they say, I'm going to start putting things away for my future, and I'm going to do it smart. I'm not going to just run out and throw my money on some Bitcoin or some penny stock. I'm going to study, and I'm going to learn what investments are like, and I'm going to learn how to do it more safely so that I don't lose it all.
Mm.
And you know, and it's an awfully tough lesson to learn. I mean, you can't believe what I see with some of the coaching clients I have, the risk that they have in their portfolios. And these are, big portfolios. You'll see a person with $1 million spread over two or three securities,
Mm.
two or three different securities. That's it. You know, one of them lights on fire and he's a third poorer. I mean, you
Yeah.
just don't put yourself in a situation like that.
Yeah.
You want to be, remember Enron? Do you remember the
Yes.
Enron
Good.
scandal?
Yeah.
When this great company was paying a good dividend, I think it was A- rated by Standard and Poor's. Everybody loved it, and it turns out it was a fraud,
Yeah.
right? So I was an investment manager, and I had Enron in my portfolios because it met all my quality standards, B plus rated, paid a good dividend, had a nice history of profitability, and so on. Who knew? Well, even my wife had some in her IRA, but I never have even close to 5% of anybody's money in any one thing.
Mm.
So when that thing, she might have had maybe a 1.5, 2% of her portfolio in it. She never even noticed a change in her market value when it went to zero because, it wasn't a whole lot of companies at the same time going bad. It was just one in a nice market or whatever.
Yeah.
So she never even noticed. That's where you want to be. You want to look at that portfolio and you're going to say to yourself, I've got this much invested in all these things. Is there anything there that if it tanks, if if the board of directors is flying on a private jet and they hit the side of a mountain, and it becomes a panic situation for the company and they go under,
Mm.
how much is that going to impact my life?
Yeah. Yeah. So
Because
is that something that is that too in the weeds to really think about, or are you thinking about these kind of things as far as like, oh, this company doesn't seem like they can keep a CEO for that long, or they make
well,
too many changes?
is it in the weeds or not? You can't. It's not predictable.
Hmm.
But you didn't predict that those airplanes are going to fly into the Twin Towers either.
This is true. Yeah.
And how many people panicked at that time and sold everything because they thought, Jesus, this is the end of the world again. You
Yeah.
know, and they did.
Market tank.
So yeah, the market went down. The market went down just like it did in the COVID thing in
Hmm.
March of 2020.
Yeah.
Okay. And it's done that. It did that in the dot-com bubble in the turn of the century. It did it in 87. I
Hmm.
know that's before your time, but
Yeah. Yeah.
87, the crash of 87 that everybody called it. That was, what really, in my sense of it all, um, it was just about the time that computers were really beginning to play a big part. Volume on the volume on the New York Stock Exchange rarely, if ever, got to 1 million shares before that time, you
Oh.
know? So all of a sudden we started to have these trading systems, these things, and they had signals, if the stock went down, it hit a sell signal in the computer. So the computer would say sell. And that of course would institute another computer sales signal, because price would go down. So my feeling was just a giant computer loop. I mean, we took advantage of it. My my principle, my approach to things was to buy the best companies, but to buy them when they're down 20% from their highs, and they went down like crazy. And I always sold them when they up as much as 10%. That's in my first book. I spell all that out. But we had plenty of cash to spend to put into these things as they went down, and we just really it was so bad. It was so bad that for Pepsi, for example, I remember saying, "What's the price of Pepsi?" And he'd say, "Oh, $27." I said, "Buy 500 shares at $17." And we'd be able to get it
Mm.
because that's how everybody was panicking. You
Wow.
know, 2 months later, I'd be selling Pepsi for 10% profit. So, you know, and that's the way it was then. But there have been three of those major meltdowns, and there's that tiny little COVID meltdown. And who knows when the next one will happen? You want to be in a position that it doesn't matter.
Mm.
And that's what my approach does. You're buying only the highest quality companies with track records and experience. You're diversifying to the point, diversifying has always been a defensive weapon.
Mm.
That's the defensive part of your team. The defense is diversification. And I take diversification to the point where I've made it become an offensive weapon
Mm.
because I own 200 of those closed-end funds I was talking about earlier
Mm.
in my portfolios, and they're all different sectors, all different places, all over the place. So if anything is going up, I'm gonna have a profit from it.
Mm.
And when things are going down, I'm going to be able to take advantage of the lower prices. So I'm constantly pushing them, moving my money in and out of different securities. I've taken profits on over 120 different securities just in the month of January,
Wow.
and one loss. All the rest were profits. So, and the loss was a mistake. Hit. I thought I had a. I thought I had a profit target on my worksheet, and I
Mm.
didn't see the underline and the S, which means it's a stop. That means it was
Mm.
something I wanted to sell if it got to a certain price, and I sold it a little below that price. So
Uh.
I lost $30 on that. I tore my hair. It's gone. No, but anyway, but you get the idea. You want to put these safety principles. You have enough of these safety guards in your portfolio that when the market tanks, it's not a big deal for you. And let me tell you the other thing about it. I mentioned those three types of funds, and I never was a big fan of funds back in the day when I was really comfortable in the stock market and all that stuff. But over time, with the ups and downs and all the craziness, I've determined that yeah, it makes sense to have managed portfolios of a lot of securities. The difference between the ETFs, the mutual funds, and the closed-end funds are that the ETFs and the mutual funds don't pay a lot of income.
Mm.
They don't pay a lot of income. And their purpose in life um, is to grow the market value of their portfolios.
Okay.
The closed-end funds, on the other hand, are what they call pass-through trusts.
Mm.
And when you get another 25 years under your belt and you're setting aside what you're going to do if you're estate for your family, you're going to have one of these pass-through trusts, maybe. What they do, they are required by law to pay out 95% of their income, their net income, to their shareholders,
Mm.
you know? And so they generate a whole lot more income using exactly the same securities as the other types of funds.
Okay.
And that's why I focus on those. That's why I focus on those. Okay. There are complexities about them. There are complexities about the others. There are differences between the two. Um, but the main difference that interests me the most is their ability to pay out more income, and you grow your portfolio by reinvesting income and capital gains. And that's what it's all about.
Something you started talking about, I thought was very interesting to pick up on was when you were talking about the rise of the computer and how that changed the access to stocks and the speed of a buy and a sell. How did that affect you, I guess, personally, and how did you see that affect the economy? I guess it was what, probably in
Well,
the early 90s we had
yeah,
internet and computers and stuff started to boom.
when
Uh,
that really came in, yeah, it really did change everything, and the volume on the New York Stock Exchange just went crazy. I mean, in the in '87, I don't think that the Dow was even at 2,000.
phew.
You know, the S&P wasn't even at 1,000. I mean, I don't have records that go back that far, but that's the way I remember it. A million share day was unheard of until after that era.
Mhm.
And today, and the thing that gave people access to the markets first was the mutual fund
Okay.
and the closed-end fund, but that wasn't as popular. As mutual funds became popular immediately and began using in corporate profit sharing plans and things like that, everybody had access to it at a lower price than going in and trying to buy IBM at $60 a share. They got a bunch of IBM just by being a member of their profit sharing plan
Mm.
at work. And that's changed a lot. It's changed a lot today. I mean, most people don't know what stocks and bonds are because all they've been familiar with is a 401k. They think a 401k is a kind of security instead of a conglomeration of bonds and stocks,
Yeah.
So that's why no people don't know what a stock is versus what a bond is today
Mhm.
for the most part. But I don't think I answered your question. So give it
Well,
to me again.
it
I'm
was really
sorry.
just about how you saw the change
Oh
in
yeah. Well,
the whole
today's changes, you can really do a lot of investing yourself because I mean, I have on my phone, I've got access to my Fidelity account, and I could go in there, look at the market, and buy and sell something right now if I wanted to,
I
right?
was gonna ask you,
And
you use
that's
Fidelity.
and that's how most people do it. They'll have a program, and they'll run their own things. Um, they can do pretty much anything. They can go on away on vacation and put in uh, instructions that if this security gets to this price, I want you to sell it. Mr. Computer, please sell it at that price, Or on the other side, this is something I don't do. They can say, sell this security if it goes below this price.
Mhm.
And I never do that, but yeah, you can do anything online and by yourself these days. And commissions are gone. There are no commissions anymore.
That's right.
Unless you call your broker and say, "Hey, I want your personal advice on something," then he clicks on the clock and you start to pay him. But just to trade, it's free.
Yeah.
They used to get almost a 2% commission on trades back in the day when I started. So when I was looking for a 5% or 10% profit, I really had to see that stock go up 12% before I knew I was getting my client 10%.
Wow.
You know what I mean? And bonds always had an invisible uh, commission. It wasn't they didn't call it a commission, they called it a markup.
Mm.
So when you were buying something, there would be a markup you would pay on top of what the price was, and that's what the house kept. And
Mhm.
when you sold a bond, there'd be a markdown. So they take a cut both ways, which is why toward the end of every year, your broker would call you and say, "Hey, you've got these bonds here that we can take a loss on that you can deduct from your taxes. And then we can buy something very similar to it that's paying the same amount of money and start over." Well, yeah, they saved you a couple bucks in taxes, but they also got a 2% commission on both sides of the transaction.
Mhm.
So
That's
I
that.
don't they that still can happen, but
Yeah. That's
not if you use the funds. to own your bonds.
Mm. Yeah, that's very interesting to know that so much has changed in a long period of time and a short period of time. And
Yeah.
I remember when I first started getting into the stock market, I had USAA with trying to do stocks, and I remember it was like $8.95 or something like that for a commission, and that was to buy and sell.
Hmm.
And it was like
Yeah.
a flat rate. And I was like, wait a minute, I have to make this much money just to be able to make a profit off of
Right.
this. So I have to pick my stocks appropriately. And then
Right.
Robinhood comes along and some other companies have come along. Fidelity's doing it too, where there's no commission. And
Right.
I think that
I
has
think Schwab started it.
Coach
They've
Schwab did.
Schwab's the really low commission, and then there got to be so many online brokerages that they just were forced to say no more commissions at all. The only there are still some fees you have to pay,
Mm,
like the federal government gets a $3 or $5 fee every time you sell one. Every time you sell a stock, you pay a fee to the government. Do you believe that?
that's
It's
crazy.
There's a guy. I think it was a movie once called Penny Parasites or something like that.
Mm,
It was about a guy who developed a program within a bank where he would take, oh, one hundredth of not one hundredth, 1/1000th of a dollar off of every transaction would trickle into his bank account. And think about that with a major bank, how much money that would generate over time.
that's a lot of money.
Yeah. So anyway, I forget the name of the movie, but it was about a guy who came up with a scheme like that. And that's why, cybersecurity is so important these days because everything's electronic. I mean, my wife beats me on the head every day. Make sure I close every, when I go to my brokerage account and I go to the bank and stuff, make sure you close out those accounts.
Mm,
Don't just leave them there and hope that they'll close you out automatically after an unused minute or something. Make sure you close those websites before you leave,
yeah.
stuff like that. Yeah, it's a big problem. My grandson's in cybersecurity. He got his degree in that, so he's working in that area.
Yeah,
But
that
we don't know anything. My generation, God, we don't know anything about that. Wow.
Yeah, that's a pretty big deal with what you were talking about from that movie. I think that's also like in Wolf of Wall Street, a little bit of what they did was the penny stock thing, and people were
Uh-huh.
make big gains off of microtransactions, and they were just trying to, accumulate over time just a lot of money off of penny stocks, and even like crypto. Crypto has become a big thing where people are trying to make a lot of money off of things that don't really aren't that expensive, but they want to buy a lot of it in volume so that
Mm.
they can make a lot of money over time.
Yeah. Do you understand crypto at all?
So, from my knowledge or what I've gained from it, I don't do it just because I don't think we understand it enough, and
Okay.
I think we've already seen a big decline in like NFTs and stuff like that. It ramped up around COVID because the US dollar started to not become as important to people, and they were like, "Oh, let's get crypto because it's more secure and all these things." But in my opinion, people your age, they've got more understanding of history, um, more understanding of where dollars have been moved, companies. Like your age people are the ones, the CEOs, and
Yeah.
you're owning the company. So like you've got more control over the economy in general. Now, my people my age are the ones out there spending every dollar that that they make. So yeah, we're kind of funding it, but we're not really controlling it per se. So I
Right.
think oh, it's my watch. When we look at crypto, everybody was like, "Oh, this is going to be the wave of the future." But it's like, yeah, our future, like my age, not not right now. So I think we
Yeah.
still have some
I
time.
I think in the future, I really don't understand it that well, and I've never touched it, and none of my clients. I actually lost a client because she was sure she had to have that.
Mm.
I have no clue how she did with that, but I've never gone there. I try to stay away from things I don't really understand very well,
Yeah, yeah,
and you know, I it's just a speculation to me. Just like I never, gold is a speculation.
yeah.
But you can in closed-end funds, I'll own a fund that owns companies that mine gold and that, sell it and
Mm,
produce it and all that stuff, and they pay, and I'm getting a 10% dividend on it.
mm.
So, it's not as speculative as if you have gold bricks sitting in your garage.
Yeah, yeah,
You can have a whole lot of money in gold bricks, but you can't go to the pharmacy and get a prescription filled.
yeah, yeah.
You know, you, so it's just I don't I like to have cash flow. I like the income. It's important to me. It's just like if you're in real estate, the important thing is that people pay their rents,
Hmm.
and you keep the rents reasonable and you keep the place in good condition, and they'll pay the rent.
Yeah,
And
in my opinion, the only people that should be working in theory is scientists. Like anybody else,
yeah,
work on the stuff that actually is tangible, like dollars. The cryptocurrency stuff, it might be a thing, but it's not there yet. And I think we
right.
still have to work on it. But yeah, leave the theoretical, oh, this could be beneficial to the scientists.
Right. And then you hear rumors that the country is going to start using crypto, and stuff like
Yeah.
that. I've heard that. You get this fake news that comes along and tells you what's going to happen, and you got to be careful what you believe.
Yeah.
You got to, I'd say when you're young, and I'm not saying you should just choose anybody, but before you go out all on your own, you got to do a little studying before you start investing your money, and then you'll find that you make fewer mistakes. And if you can find a person that you trust, all the better. If you know somebody that's been there, done that, you know, successfully. And for by all means, if you ever do, go to a broker and ask to see his portfolio
Mm.
before you buy anything that he recommends.
Yeah.
I want
Yeah.
to see what you own in your portfolio.
I would have never thought to do that. That's a smart thing.
Yeah.
See what they've done.
Show me what you do.
Yeah.
Well, hey, I just got here. I don't know. I don't have any investments. Well, then how are you qualified to tell me what to do? You know what I mean? The guy's got to have, if you're going to take advice from anybody, he better have a good six-figure portfolio to show you what he's done.
Mm.
That's my advice.
So, give me something from the book that you were really excited about to tell people, and you just felt like people probably just didn't know this, so I'm excited to put this in the book.
Well, two things. Retirement money secrets. Secrets are really something that shouldn't be secret. The things I mentioned before, the quality, diversification, income, profit taking, those are principles. Two other things like, hey, the market is not a straight upward line or a straight downward line. It's a lot of lines going in different ways with an upward trend, but it's always going to be up and down. It's called a market cycle, and you have to put yourself in a position to take advantage of it, which regardless of which way it goes, and you need to be able to grow your income whichever way it goes.
Mm.
So that's one thing. And the other thing is focus. Focusing on market value doesn't really pay any bills for you. It just builds your ego when it's up and it makes you sad when it goes down.
Mm.
Income, your focus has to be growing your income so that someday you can say goodbye to your employer and do whatever you want to do. The other thing I think what it introduces is the concept of these closed-end funds, which is a way that anybody can start. You can own the most expensive of all the stocks in the stock market for $15 a share within a managed portfolio of stocks,
Mm.
even lower. The average price of the 100 equity closed-end funds I own is probably only about $15, maybe less. So you can do that. You can buy uh, all those stocks in a package more cheaply, have more more shares. Instead of going out and buying one share of Tesla, you can own 1,000 shares of Tesla by buying a closed-end fund, for, $15 a share.
Mm.
You know what I mean? So you do instant diversification and more income. So I introduced that. I introduce what really is the oldest of all managed funds
Hmm.
in a book written in 2024, 2023. It's introducing the oldest of all investment vehicles, other than the individual security themselves, the oldest type of fund. So that I think that's really the biggest thing. It's people just don't know about it. You can go to your advisor and ask him about it. He won't know,
Mm.
you
That's
know. So
that's good. That's good stuff. That is a secret. That is a retirement.
yeah.
All right.
So even if it's not great for your audience, you should all get the book for your parents or your grandparents, depending on how young you are. Right? There
Absolutely.
you go.
So let's go ahead and wrap this up. Let's give everybody any way they if they want to reach out to you or your website, of the
Okay.
book itself, everything.
The book is for sale everywhere. Amazon, of course, is the easiest place. It's a Kindle, 9.99. You can get it. Um, my website is theincomecoach.net. So it's that easy. You can contact me directly through that if you want to, and it'll tell you all about my coaching practice. But I would recommend for most people, particularly if you're just starting or you're new or you've got a preliminary portfolio, under six figures and you want some guidance to get it above six figures, read the book. It'll get you there quick.
Awesome. Well, thank you so much for coming on. It was a pleasure to talk to you and learning about the different kinds of bonds and stocks and how we should save our money differently and how we should diversify and stay away from companies like Enron.
If you could only know which ones to stay away from, right?
Yeah, yeah,
Yeah.
absolutely. But it's been a
Okay.
pleasure having you on.
Yeah, it's great talking to you, Jackson.
Awesome.
Good
All right.
luck.
Well, thank you for everybody for tuning in. We'll see you next time.